technical analysis, which will help you become a better trader. Now, technical analysis doesn't work or is not required for long-term investing or understanding mortgages or understanding finance or insurance or understanding the stock market in general. But if you're looking to make short-term investments, make trades, you cannot do it without technical analysis. Now, technical analysis is the study of price movements on a financial chart. We can think of technical analysis as some sort of framework that traders use to study and make use of price movement of a market. Or in other words, looking at a chart and being able to understand what it's telling you and how to read what price action is telling you. Technical analysis focuses exclusively on the study of price charts and trading history to determine the future price movements. Now, I call technical analysis chart analysis because anything and everything we do on a price chart, whether you're just looking at it, whether you're flipping through, whether you're circling a high and a low, whether you're doing whatever, if you just want to see what Tesla's doing and you open up a price chart on, Wall Street Journal and you look at the price chart, that's technically technical analysis. So let's not use this big term and let's stick with the word chart analysis. Now, the primary reason that traders use technical analysis is to make predictions about future price movement based on past price movement. Technical analysts believe that all current market variables are reflected via the price movement or the price action on a chart. So if we believe that the market variables are all reflected via price movement, it only goes to reason that we don't really need much else to analyze and trade the market price. Now, I am a technical analyst, although I don't use indicators and oscillators. I don't use those involved mathematical for it, but I look at my financial charts, I look at support and resistance, I look for chart patterns, and I look at historic prices. Now, we don't want to ignore fundamental analysis, which is news, headlines, earnings reports, press releases, but we don't rely that heavily on them. Technical analysts look for patterns on a chart that tend to repeat themselves. They do this to develop their trading edge. The underlying logic here is that since most price movement is driven by human beings, certain patterns will repeat themselves in the market as human beings tend to be repetitive in their emotion and their interaction with the markets. So let me pop up a live price chart here for you. Let me get one up on your screen. Okay, we're looking at the Euro-US dollar live chart. Now, first, let's break down charts. There are three main kinds of charts. The most simplistic is what we call a line chart. It doesn't really tell you that much information, but it gives you a general view of the market. After that, we go to what is known as a bar chart. Now, bar charts were the most popular type of chart in the market until we came into online trading, and developers were able to develop easy, advanced Java and HTML charts. Now, a line chart, a bar chart, tells you a lot about what's going on in the market. You can see the high that it reached during that time period, the low that that asset traded during the time period. You can see the price it opened at in that time period and where it closed. So we can see a whole story of that time period. So if we were looking at a daily chart, each one of these bars would represent 1 day of trading. We're looking at an hourly chart right now. So each one of these bars tells us about what the market's been doing over the last hour. Now, what do we see with the Euro-US dollar? Since the 23rd, it's been steadily climbing upward. We have a beautiful uptrend, and we can see that in price. We can also see it's dropped back down, move back up, drop back down, and it should be moving back up again because price doesn't move in one direction. Price moves in push, ease, push, ease, push, ease. But if it decides it's not going to move back up and it's going to correct lower, we would see this immediately in our price charts. We could see this by reading the bars and the type of bars. We see the strength of the market by the length of the bars. So we understand who's in control of the market, how vivid the market is, how volatile the market is. Now, today, the most popular type of charts are candlestick charts. Now, if you notice, the candlesticks and the bar charts were pretty much the same, except these are red and green instead of just black bars. Now, candlesticks are the oldest type of charting. It came to the U.S. or it came to the popular markets from rice traders in Japan. It's several hundred years old. Now, candlesticks work very well. They're not about the reds and greens in general. They're about the shape and the size of what we call the candle, the body of the candle, and the wicks. It gives us a better look than the bar chart does in what the market is doing. We can see we have a very long body. That means price moved a great difference, and it opened up here and closed down here. Why? How do I know that? I know that because we have a red bar. So to make a candle, we put a line across at the open, and if the price fell to the close, we put a line across below and make it red. If it climbed from the open to the close, we make that a green candle. But we can also see how volatile the markets are by what's called the wicks, or shadows, which are these lines that go above and below the opening. So we can actually tell a whole story of who was in control of the markets. And this is just by looking at a price chart, we can tell a whole story. And then we can develop strategies on how to use these price charts. But once we've taken a look at price charts, we can then start looking at patterns. Now, these red and green and blue lines I have across my chart, these are called levels of support and resistance. I've placed these on the charts. Okay? You would place these on your own charts because of one of the ways you become a better trader than the guy next to you. These lines come from way back when in history. By going back in your charts to prior periods, you can see that the last time that the euro was trading at this level and what price was important. So the last time we can go back in history and see when the euro climbed from the 120s up to the 121 range, we can go back and look at that and see, well, maybe the price got stuck at 120.50, and then maybe it climbed above it to 120.57, but it got to 120.99 and couldn't break through. So we could then tell or predict what price levels will be important today. Now, the color coding, these gold, red, are my personal keys. You can decide how you want to key these. Like my dashes tell me that these were minor support and resistance from a most recent trading period. My blue tells me this is a long-term price line that was very important back years ago. My gold tells me in the last run-up that this was an important price level. So I can then use this to predict what's going to happen in today's or the current market. So we can see as price climbed up, it tried to break through here, couldn't get up to this next gold level, but where did it fall back down? This, we can see opens and closes level. Then it fell below, came back to this price level here. Now we're probably going to see a decline here. We're going to expect some type of action when it hits here. It can go right through, nothing stops it. But we would expect some type of an action at that level. So that gives us clues about what we can expect in the markets. We can also go over and start putting on here what we call price patterns. Okay. Price patterns are one of the most popular ones, the most well-known ones that's been around for hundreds of years, is a triangle. When we can build this triangle around price movement, we can see the price is moving into the apex of the triangle. Now, forget all the rules about triangles. You don't need to learn those. But we know at some point it will break out of that triangle. It can break up or down, but when we see that break, we can make some trading decisions. As you can see, I've already set my first target, my second target. I'm looking for my buy zone, all at that breakout. Well, here I could have entered a very, very nice trade, and it would have made my first target, wouldn't have made as far as my second, but when it broke my first target, I would have gotten out of that trade, and I would have made myself a good little profitable trade. We can see here on this chart also a triangle pattern. Now, there are many popular chart patterns, and these have all withstood the test of time. There's always some guru out there coming up with something unique. I mean, I've seen exploding volcanoes, bat wings, you name it. But head and shoulders is one of the most popular. We have double tops, triple bottoms, rising wedges, flags, and pennants. We can also go as far as seeing all the different types. We have bull flags, bull pennants, descending wedges. I group most of them into triangle formation. Whenever two lines are converging on each other. But these are very, very popular patterns to help us interpret the market. So when we see and get our support and resistance on the charts, and we start to see some type of trading movement, we can start deciphering what the market is trying to tell us. So let's go back to my PowerPoint. So technical analysis also encompasses learning to analyze the market structure, find trends, support and resistance levels, and generally learn to read the ebbs and flows of the market. There's obviously discretion involved here. And I'll be the first person to tell you that technical analysis is more of an art than a science. In other words, what makes you better than the next guy. It's your artistic ability. Now, that said, it is something you need to get comfortable with. And the longer you do it, the better you do. I describe it as a roadmap. Many years ago, now I've been trading for over 30 years. But I had a business partner, and we used to do investment together over 30 years ago. Now, we didn't have GPS in those days. We didn't have mobile phones. So whenever we'd go for an appointment, and we were in London, whenever we go out of London for an appointment, I would drive, and Peter would get us there. The reason I drove was because I hated reading roadmaps. Now, Peter was an expert at roadmaps. I'm telling you, I was the guy who would get off at every mobile, every dial phone, payphone, and call and say, okay, I'm at the mobile station on the second roundabout. What do I do next? Peter would pull out his trusty map, and he'd say, take the third exit off the roundabout, go 3 miles, look for the church, turn right at the church, go 2 blocks up past the filling station, and you'll see the parking lot on the left. And we would never get lost because he was so good at reading those maps. When we were on the highway and there would be an accident, he could pop us off at the next exit, get around the accident, get us through all the little villages and back on the highway without ever making a wrong turn. All that from reading his road atlas. Me, I don't know how many telephone calls I would have made, how lost I would have get. I used to leave my office an extra hour early just to make up for time when I got lost getting to an appointment. With Peter, never got lost. Okay. Now, a chart kind of looks like a roadmap. It gets you where you're going. So most traders instantly think of a price chart like the one we just looked at, and someone mentions the word technical analysis and they freak out. Because technical analysis sounds complex and complicated. Now, have you ever heard the adage, history tends to repeat itself? Technical analysis is a method of predicting price movements and future market trends by studying charts of past action. Now, one major advantage of technical analysis is that experienced analysts can follow many markets and many instruments simultaneously. Now, it breaks down into many sectors. Reading price charts, we looked at bars and candles. Okay, trends and trend lines. Trends, markets move and push and ease, push and ease. Now, most of the time, well, I have a little personal say that the market and market price is completely random. It's made up of millions of human beings making decisions. But there are certain times that the market will exhibit non-random behavior. When we see this non-random behavior, we can then apply some rules to that market and make smart trading decisions. And those are called trends. And when we can put a trend line on a chart and our support and resistance levels and see a chart pattern, it means that the market is trading in a non-random fashion. Then we go to what most people freak out over, and then lots of people just talk about all the time, and most people don't ever master. It's called indicators and oscillators. and number theory. Now, let's go back onto a live chart for a second. Now, most indicators are dropped on a chart below price. Some are dropped on a chart over price. So we have something as simple as a moving average, which is just a line dropped on a price chart. That is a technical indicator. Then we have trading strategies that use two indicators, two moving averages, and you can trade a crossover strategy. But then we go to indicators like Bollinger Bands, which is literally dropped on this used to be in, hold on a second. There we go. Bollinger Bands, which is dropped right on the price chart over top of price. Now you have to learn how to use each of these indicators and oscillators. But they are complicated. You have to learn how to interpret them and how to read them. But then we also have a whole big group of them called oscillators, which get pushed below the chart. And some of the most popular ones are MACD, which is my favorite, and stochastics, which is used a lot in our market, and relative strength index, RSI. And these are all placed on the bottom of the charts. And they tell us something about price action. Too many traders want to master these and just trade from those. But an indicator is simply an indicator. Indicator indicates. It's an interpreter of price action. Price action is always should be the first thing you look at. And then you can add on things like oscillators and indicators below your chart or on top of your chart. But you shouldn't be building a trading strategy simply based on a couple of indicators. Because oscillators and indicators often, many have shortfalls, many have advantages, many do different things. But the fact is, you can't master them at all at one time. But they can assist you with an entry point. Only technical analysis or chart analysis will help you find an entry point for a trade, will help you find an exit point for a trade, will help you find where you should put your stop loss. All of that is done by looking at prices on a chart. And all of this encompasses what is known as technical analysis. Now, it's not some big scary thing. It's a way for us to easily interpret the market and understand what price is trying to tell us. And these are, especially support and resistance trend lines, chart pattern, are easy concepts to learn. And then there's no rules. You see them on your charts. You figure out and you look at back and forth what happens when price breaks out of a triangle and write your own rules. Okay. But once you get it down pat, just like reading a map, and once you understand what the wide the colors are and what the narrow colors are and what the lots of the reds and the greens are and what a stoplight signal is and what a crossroads signal is, you'll have it down pat in one way and you will start trading successfully. So the most popular forms of technical analysis are simple moving averages, support and resistance, trend lines, and momentum-based indicators. So what's a technical indicator? An indicator simply indicates. It helps you interpret the use or what price action is telling you. When you can't interpret what price action is telling you by using trend lines, support and resistance and chart pattern, an indicator might help you figure out what it's trying to say. Indicators serve three broad functions: to alert, to confirm, and to predict. An indicator can act as an alert to study price action a little closely. If a momentum is waning and if the signal to watch for is a break of support, alternatively, if there's a large positive divergence building, it may serve as an alert to watch for a resistance breakout. indicators can be used to confirm other technical analysis tools. According to some investors and traders, indicators can be used to predict the direction of future prices. A technical indicator offers a different perspective from which to analyze price action. But remember, indicators only indicate. Even though it may be obvious when indicators generate buy and sell signals, the signals should be taken in context with other tools. They're not really giving you buy this, sell that. They're giving you a smack on the back of your head and saying, hey, here's an opportunity. Many traders swear by them to help with the timing of their trades or to alert them of trends. But even as for an investor more focused on underlying fundamentals of companies, learning how these indicators work can provide added conviction on a new or existing trend. So most of the indicators tell us momentum. It's like shooting a firework into the sky. It's going to go up and up and up, but sooner or later, it's going to start losing its momentum, and then it's going to turn and fall back to earth. Well, if you can see precisely where that momentum starts to deteriorate, you can get out of that trade or predict what that trend line is doing. And then we have others that tell us about volatility. We have volume indicators. Okay. But oscillators are most reliable in periods where there is no clear trend in the markets. So technical analysts consider the market to be 80% psychological and 20% logical. Fundamental analysts consider the market to be 20% psychological and 80% logical. Psychological or logical may be open for debate, but there is no question the current price for security. After all, it is available for all to see and nobody doubts its legitimacy. Price never lies to us. Price is price is price. No matter what chart you're looking at, no matter where you are, no matter what your time frame is, no matter who you are, price is always the same. So what do we know? Or what can we learn? What is the price? Where has it been? And where is it going? So even though there's some universal principles and rules that can be applied, it must be remembered that technical analysis is more of an art form than a science. So remember, what is the price? Where has it been? And where is it going? So if you want to learn more about technical analysis of the individual fields of study in technical analysis, just sign up for some more classes at Just Learn Academy, and we'll help you master support and resistance, price levels, charts, trend lines, oscillators, and indicators, or anything you want to learn about the financial markets. So thank you very much for joining us. Have a great trading day, and we'll talk to you again real soon.